Hey, Jason here. In today's video, I'm going to answer the question, should you invest in cannabis stock HITI Inc., stock ticker HITI. This is an investment analysis for Jimmy W., who requested this on YouTube. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe to the notification bell so you're notified every time we release a new video, and we release new videos all the time. Okay, I apologize for this. I don't want to do this, but I have to do this because every time I don't, I get nasty comments. I do not short sell ever, so I don't benefit from talking negatively about any stock that I talk negatively about. I also don't own any stock in a long position in any stock I talk positively about, so I don't benefit from that either. I'm doing this to help you learn how to evaluate stocks better and faster, so you can spend more time evaluating good stocks by discarding the crappy stocks faster. These videos for the last 3, 4, 5 months and for the next month or so is viewer requested. Because of that, I often don't know what the company does, and I purposely keep it that way. So I don't bias, so I'm not biased either negatively or positively as we go into these analysis videos. Because of that, though, and because at this stage of my analysis, I don't care about what a company does. I don't care about what it says it's going to do. I don't care how great the company's CEO says its future prospects are. I don't care at this stage of my analysis. That's for far down the line at this stage of my analysis, which is the second stage of my analysis. We have to have minimum margin of safety, minimum margins to continue researching the company. Why should you listen to anything I have to say? Because in the first 9 years of my career, I've produced average annual investment returns in the portfolios I manage, of 23.5% per year on average. This puts me just behind the great Warren Buffett, who produced 24.2% average annual investment returns in the portfolios he managed at his Buffett Limited Partnership, and my returns legitimately make me one of the best stock pickers in the entire world over the last 9 years. I don't say that to brag. I say that to prove to you that I actually know what I'm talking about a little bit. Okay, again, I apologize for that. Don't want to do it. Have to do it to avoid the nasty comments. Okay, today we're getting to HITI Inc. And wow. First thing that jumps off the page to me here is they've had an exciting year. They've had a low of 44 cents per share, and they've had a high of a 149.25 per share. Right now, they're selling at $6.23 per share. I want to see the stock chart on this one because that is crazy. So that's the last year. Okay, so they really shot up this year in January. I'm wondering if that's anything to do with the presidential election and people thinking that marijuana is going to be legalized or at least decriminalized in the U.S. I'll go into more details about that shortly, but I don't see the 44 cents on this stock chart. So I don't wonder if they had some kind of reverse stock split, maybe a SPAC. I'm not really sure yet. Let's see. Okay. HITI Inc. is a downstream-focused retailer of cannabis products, distributor and seller of smoking accessories and cannabis lifestyle products. It is a vertically integrated company in the Canadian cannabis market with portfolio subsidiaries, including RGR Canada Inc., Famous Brands Inc., Kush, blah, 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 their brands. HITI's aim is to extend, that's why I'm struggling here because the word is not there, is to extend and strengthen its integrated value chain while providing a complete customer experience and maximizing shareholder value. It generates most of the revenue from retail stores and e-commerce platforms. This is important. These 3 words, maximizing shareholder value, are important. We will see if they're actually maximizing shareholder value in a little bit. But when a company says one of their focuses is to maximize shareholder value, usually, at least they want to portray that they want to maximize shareholder value, and that encompasses a wide range of things like proper capital allocation, not overpaying for acquisitions, maximizing profits, all that kind of stuff, with a key emphasis on profits.
Working?
I apologize for that. People barging into the room as I'm making a video. Okay, where was that? Oh, the for an investment newsletter I used to write for, one of the things I wrote about and covered was the cannabis market. So I have an enormous amount of knowledge of this industry, especially Canadian companies, and I will get into some of those details here in a little bit. So I do know quite a bit about this industry. That will color my analysis going forward, but still, we're going to focus on the numbers as they are for now. Okay, revenue skyrocketed, not surprise. 2018 at 9 million Canadian dollars, CAD, to 128 million in the trailing 12-month period. That's a huge growth rate. Frankly, again, not surprising because the Canadian market has opened up, I think, completely. To completely now, because in, was it last October, November, something like that, they opened up to the edibles market. It was open before to that for leaf marijuana, but now it's opened up, I think, pretty much fully for beverages and all that kind of stuff. Operating income is negative, not a surprise. Most companies are not profitable right now on an operating income basis, net income basis, and free cash flow basis in the cannabis market in Canada. I'll get into the reasons as to why shortly. But that also means their operating profit margins are negative for most of the last 1, 2, 3, 4+ years that they've been public. Again, not a surprise, not a good thing, but it's not a surprise. I look for anything about 5% or 10%, sorry, on a consistent basis for operating profit margin. The share counts has skyrocketed from 13 million in 2017 and even 15 million last year to 45 million in the trailing 12-month period. When we get to the cash flow statement, I want to see if that's related to options or something related to the IPO. If they sold shares, they probably sold shares on the stock market because the share price was so high. But we'll see what that looks like when we get to the cash flow statement. Book value per share, not really enough time to see here if this is going up or down, but it is up slightly from 2019. Cash flow, negative for most of the time they've been public. ROIC is negative. Again, not a surprise, but not good. I look for anything above 10% on a consistent basis. Right now it's negative 19.5. Bigger concern, that's not good, obviously. But the bigger concern here for me initially is ROE at negative 48.2% compared to, in the trailing 12-month period, compared to negative 19.5% in the trailing 12-month period for ROIC, indicates the company has a lot of debt. Why? Because ROE is magnified and leveraged by debt, while ROIC is not. Our debt is stripped out of ROIC, so this means they have a lot of debt. We'll see that on the balance sheet. Negative free cash flow to sales. Again, I look for anything above 5% on a consistent basis here, so this being negative most of the time since they've been a public company, and hugely negative in 2018, 2019. It's not a good thing. Was positive last year, is back negative this year, though. I do have a decent amount of cash. Again, selling shares is probably part of that. Maybe issuing debt. Looks like they might have issued shares to pay off debt because they had a huge amount of debt as their balance sheet in 2019 at 48.2%. Now it's only 11.1. Also could be just that their balance sheet has grown. So as a percentage of their balance sheet, long-term debt went down. Intangibles, they have a huge amount of intangibles. I'll get to that in a second when we get to the balance sheet. Typically not a good thing because it's come from acquisitions in the cannabis arena in Canada, and that those acquisitions have been in general massively overpaid for. So this is probably a lot of goodwill, and I will tell you what that means if and when that is the case. This is interesting. Cash conversion cycle is down enormously from 261 days in 2017 to 8.5, 9 days in the trailing 23. That generally means the company is becoming more profitable or more efficient. Sorry. In this case, we'll have to see because it's taking them a lot less time to sell stuff. That's good. They also have a lot less inventory. That's good. And kind of paying people about the same time. Inventory issues were huge issues last year, the year before, for a lot of cannabis companies because there was a huge oversupply of marijuana and marijuana products. What happened in Canada is once they opened things, a huge amount of suppliers came in and started doing things legally. And that led to a massive oversupply. And I'm going to bring back my face here for a minute so I can show you. So the demand of marijuana is going up kind of slightly like that in Canada. The huge influx of supply, though, of people creating legal marijuana, huge supply went almost straight up like this. It went like this, and then when it was legalized, went almost straight up like this. When there's huge oversupplies of things, it means lower, and demand doesn't rise at the same rate. It means prices typically go down. Lower prices mean lower sales, and lower sales typically mean lower profits and lower cash flows and unprofitability, which is what we saw, again, 2018, 2019, 2020, for marijuana in Canada. What that led to is a huge amount of unprofitability, or what that unprofitability led to is a lot of acquisitions, a lot of mergers, a lot of buyouts, a lot of bankruptcies. That happens in any time, or this kind of cycle happens anytime there's a major new kind of innovation or law change or deregulation or whatever. The cycle happened, a lot of acquisitions, which we'll see when we get to the balance sheet, were overpaid for though, which leads to more issues. And let's get back to that, and then I'll explain some of the other stuff in a bit. Okay. Okay, I explained this in a bunch of videos, but it's important to note every time you see it. Interest coverage ratio measures the interest, or if a company can pay its current debt payments or the current interest on its debt payments with operating profits. Of course, it can't because it's unprofitable on an operating profit basis. Anything above +1 is considered good. The higher number being the better. What this means is that the company has to issue shares to pay its current debt. That's typically not the best way to do things. Okay, so at the quarterly. What size is this company again? 312 million. They have about just under 10% of their market cap is in cash equivalents and short-term investments. That's a good amount. Decent amount of property. Okay, so here's the goodwill I was talking about. They have 37.1 million in goodwill as of Q2 2021, which means they acquired another business in between Q1 and Q2 because their goodwill was lower before that. Goodwill is simply an accounting number that shows, let's say a company has a book value of $1 million and but they get bought out for $5 million. The company that buys them would put a goodwill charge or a goodwill asset of $4 million on their balance sheet. It's the amount that the goodwill measures the amount that a company pays for an acquisition over the book value of the company. Book value is total assets minus total liabilities. Now, yes, this doesn't mean book value doesn't mean as much as it used to, because a lot of companies, or most companies now, operate more off their balance sheet than they used to. But still, this is one sign the company may have paid an overvaluation for them. and specifically for marijuana companies, I know, I'm not saying this company did, but in general, they massively overpaid for a lot of their companies that they acquired, which leads to more goodwill. That's fine. It doesn't really mean anything economically, though. Goodwill is 99% of the time useless in like an economic and operating situation. The only time it really matters is when the company has enormous competitive advantages. We're thinking like Coca-Cola, Altria cigarette maker, Altria, which I just did a video on not too long ago. Those companies have what's called economic goodwill. This company does not. Yes, it might have powerful brands, but when you think about economic goodwill, you're looking at, again, the top companies in the world. What does that mean for the valuation of the company? I write 100% of this value off, almost 100% of the time. So when that happens, when I do a valuation, this lowers the book value of the company by $37 million, lowers the total valuation of the company by $37 million. I do this again because most of the time it's useless, and it's most of the time, I'm not going to say it is here, but most of the time it's a sign of poor capital allocation as well if you have a ton of goodwill and it's growing, unless you're a gigantic company. Okay, they have a lot of licenses and rights. I want to know what those are. I know some of that's like the Canadian like right to manufacture, right to distribute, stuff like that, but I would want to know what that specific amount is because that's a large amount, almost $52 million. Okay. Most of their assets are in intangible assets. Again, not usually a great thing unless you have patents, unless you have something to protect those. That's usually not a great thing. Do have a decent amount of debt. More debt than cash, but not, frankly, as much debt as I was expecting based on how big the ROE was compared to the ROIC. And frankly, it's not even a huge concern. Yes, they can't pay their current debt or the interest on their debt with operating profits, but they have issued shares, issued debt to stop that. Again, is it optimal? No, but it's not necessarily a huge red flag for this company because debt isn't massive. Okay. Now, cash flow statement. Sale of business. They sold something for $10 million in quarter 1, 2021. They purchased something in quarter 2, 2021. Repaid debt in 2021, quarter 2, 2021. Other than that, here we go. That's what I was looking for. Proceeds from issuances, exercising of stock options, warrants. Okay, so this is, they likely had some deal upon IPO of somebody had warrants, maybe when they were private, or maybe they had an investor after they become public and they need some money, and they gave them some warrants, stock options, stuff like that. That's most likely what this almost $10 million amount is here. That's why their stock has been diluted by a huge amount. Was it 13 million shares up to 45 million shares? Share dilution is not good, pretty much ever, especially for tiny companies like this one. Especially over the long term. In the short term, it's not a huge deal, but over the long term, it acts like inflation. And most, it didn't obviously show that here, but in many stocks we've seen where there's been massive share dilution, there the share price goes down drastically. I think we saw one that was down like 97% because of massive, or in large part because of massive share dilution. At this stage, I would not invest in this company. It's not terrible. It's not, frankly, it's not even close to the worst marijuana stock I've seen, but it doesn't reach my threshold for profitability, stuff like that. But let's see what is on for evaluation. Struggling here. There we go. Okay, we can't see most of its valuation metrics because it's unprofitable. However, the ones we can see, whoa, are massive. I don't care about price to cash flow much, but when I do, I want it to be under 20. It's 115 rounded up. This is the important one. Enterprise value to EBIT. I look for anything below 8 here. This is 307.75, 308 rounded up. I look for anything below 8 to consider the company undervalued. So for this reason of its massive overvaluation and also it not meeting its thresholds or its metrics in terms of profitability, I would not invest in this company. That may lead you to the question of, why is it not meeting its thresholds for profitability? This gets back to the conversation I started earlier with the oversupply and stuff like that. One stat I saw from the Canadian government, this has probably been updated, but at the time, what I saw from the Canadian government is these legal pot companies, these legal pot stocks, I think it was just all legal pot companies. I don't think it was just pot stocks. So they could be private companies too. But the average, I think it was per ounce price for marijuana in Canada was something like $7, $8 per ounce. The average street price was like $3 or $4 per ounce. So not only was there a massive oversupply issue, remember I talked about supply goes up like this, demand kind of goes like this, which leads to lower prices, lower sales, lower profitability. The street value versus the legal value, it was almost double. The legal value was almost double, which led people, at least according to the report released by the Canadian government, to buying more from the street. Again, I don't know if that's still the case. I think that was 2019, maybe early 2020 when I saw that report. So that may have changed. However, the economics are still not great. Yes, they're consolidating. Yes, the economics will improve in the industry. But for now, the economics are still not great for most pot companies in Canada. And when this comes to the U.S. and marijuana, again, whether you think it should be legalized or won't be legalized, it will be. It's to some degree legal, I think, in 45 states now, out of 50 states. And at some point, it will be decriminalized and or legalized at the federal level. Again, whether you think that's right or wrong, it's coming. The same process is going to happen in the U.S. Demand will probably go up maybe a tiny bit like that. Supply will go up because everybody will be manufacturing it. Things will crash. There will be this huge boom, and then things will crash, and then companies will begin to consolidate. Why am I so sure this is going to happen? Because it's happened for at least 100 years. This happened, I don't know if it was first happened, but the first major issue or first major example of this was John D. Rockefeller in Standard Oil. He figured out how to use oil, how to manufacture it, how to refine it. Huge oversupply because everybody saw how much money he was making. Consolidation. In that case, he bought a lot of the companies out and either shut them completely or integrated them into his company, Standard Oil, to build, I think, based on inflation, the world's most valuable company, or maybe the second most valuable company, maybe behind the, what was the one that caused the South Sea bubble? It's escaping me right now, but the trading company that was, I think that was the first, and I think Standard Oil might be second, based on inflation. So this is going to happen again in the U.S. It's still happening in Canada. It's going to happen all over the world whenever it's legalized all over the world. Watch out for this when it happens. Can you make money? Yes, in these cases. But you're going to make more money after the industry consolidation and bankruptcies happen. You're going to make more money after that, and things kind of profitability starts to creep up for these companies. That's why I pretty much tell everybody right now, unless you're finding a picks and shovels play, unless you're finding a company like Scott's Miracle Growth, which is an ancillary, and they're a picks and shovels play as well. They make equipment for cannabis growers, and they have shot up enormously because they are enormously profitable because they're selling equipment that people need and use constantly. And again, as that happens in the US, they'll probably make even more money. But most pot companies, again, manufacturers, distributors, sellers, they're going through that kind of cycle we just talked about. So I hope I explained everything well enough. I hope, if I didn't, let me know in the comments below. If I didn't explain something well enough, if I should explain something better, if I missed something, let me know in the comments below. Let me know your thoughts on the context as well, the Standard Oil stuff, industry consolidation, the pricing in Canada. If that's changed, let me know. If I missed something, again, it doesn't really affect my analysis because the company's still not profitable. But I would still like to know that just out of curiosity's sake, frankly. If you want me to analyze a stock like this for you, let me know in the comments below. Every stock I've evaluated for the last 3, 4, 5 months, every stock for at least the next, actually it's down to about 2 weeks now, is a viewer request. I am now giving preference to masterclass students now that we've relaunched that. However, if we don't have any requests from masterclass students outstanding, which as of right now we do not, I will add you to the your stock recommendation to the calendar if it meets 3 criteria. It's not a bank because I don't evaluate banks. It's not an insurance company because you actually have to dig into the annual reports to evaluate those. And it also has to be producing revenue. Why? Because when I first started this, I did some stock analysis videos of companies that were producing revenue, and they were boring. I didn't have anything to say because, again, at this stage, I don't care what a company says it's going to do. It has to. This stage is 100% based on the actual numbers. So if it meets those 3 criteria and you want me to look at a stock, let me know. I'll look at a stock for you anywhere in the world. If you're listening on YouTube, thanks so much. Really appreciate it. Make sure to like, love, share, subscribe, comment, all that good stuff. And if you do subscribe, make sure to hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on the podcast, again, really appreciate it. Make sure to do all that same stuff. But on the podcast, we really appreciate a review because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more specific help on how to become a better investor faster, make sure to check out our free resources below, including our 5 free gifts where you can get the full worksheet, the actual written worksheet that we just went through the visual portion. You can get the actual worksheet as part of the 5 free gifts below, so you can analyze stocks like this yourself. You can also get a free PDF copy of my book, How to Value Invest, and a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass. We've already started getting students in. We just officially relaunched it on August 3rd. I'm recording this on August 9th. Getting more students in. We'd love to have you. And if you're looking for more information on that, you can get it at the links below. But until next time, have a great day. Talk soon.